Welcome, everyone. I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance, the leading association for lower middle market private equity funds and investors. The SBIA is an alliance for professional fellowship, business opportunities, innovation, regulatory expertise, and market data, and works on behalf of its members as an advocate for policies that promote competitive markets and robust domestic investment for growing small businesses. We are pleased to continue our Fall Lunch and Learn webinar series with today's session, SBIC to BDC conversion. Our educational webinars provide valuable content for our members, industry colleagues, and when the topic is relevant, the management teams of investor-backed portfolio companies. Last year, SBIA produced 16 webinars that attracted more than 1,000 participants. Before we get started, I'll cover just a few housekeeping items. If you look in your GoToWebinar menu bar, you'll see the questions feature. During today's webinar, you'll be prompted to share your thoughts and experiences here. And if you have questions during the presentation, this is where to submit them. While I go through the rest of the housekeeping, feel free to go ahead and let us know if you're in the process of an SBIC to BDC conversion or if it's something you're considering. Also, please use this feature to let us know if you're having any technical issues. Today's technical director, Ainsley Stoy, will reply with suggestions. Please note that this session is off the record. Comments, statements, and materials are for the express use of SBIA members and are not to be published or recorded without approval by SBIA and the professionals at Eversheds Sutherland. Today's session is possible due to the support of our valued Vanguard sponsor, Eversheds Sutherland. Eversheds is a global top 10 law practice with more than 3,000 lawyers working to deliver complex, multi-jurisdictional legal services. Eversheds has a nationally recognized investment management practice with particular experience in structuring SBIC subsidiaries of business development companies. Joining us today, we welcome firm partner Cynthia Cruz. Cynthia counsels companies and alternative investment funds in their quest to grow their businesses, especially in the crucial area of raising capital. And she works with management teams and boards of directors to develop strategic plans and timing for critical decisions. Cynthia is widely recognized as a leading advisor to BDCs and SBICs and currently serves as executive partner of Eversheds Sutherland US, where she is on the global executive management team and the global board. Joining Cynthia, we welcome Stephanie Hildebrandt. Stephanie brings a thorough understanding of corporate transactions as a member of Eversheds Capital Markets and Investments Practice Group, advising clients on a broad range of corporate and securities matters, including corporate governance, disclosure, regulatory, and related compliance matters. Cynthia, it's now my pleasure to turn the virtual podium over to you to get us started.
Hello, everyone. We're going to talk today about the process on how to convert an SBIC platform into potentially a BDC platform. We're going to talk about some of the potential structures, the timing consideration, legal hurdles that you may experience. So just to start us off, I thought I might talk a little bit about the genesis of BDCs. I don't know if everybody knows, but actually since the SBIC program has been around since the 60s, that a number of the BDC rules actually came from SBA regulations. Especially there was a number of families of SBICs, and there was relief granted by the SEC, which was replicated when they put together a lot of the legislation. There's about 10 BDCs that have SBIC subsidiaries, and some of them started anew, some of them were converted, and others have just been interested in the program overall. So what is a BDC? A BDC is a closed-end fund. It's obviously regulated by the SEC, but where did they come from? So back in the 80s, Heiser, who was a private equity sponsor, effectively said that they needed a solution to the fact that they were going over 100 investors. And if you go over 100 investors, you basically need to be registered under the 1940 Act. But Heiser went to the SEC, I don't think got much traction. Then he went to Congress and said, look, I can't really become a part of the 40 Act because it doesn't work from a leverage standpoint, meaning I use leverage. Secondly, I incentivize through carry. There's really not a capacity to do that under the 40 Act, and I use affiliate transactions in order to grow some of the portfolio companies we have. So as a result of that, effectively Congress came up with business development companies. And in addition to providing more flexibility for leverage, incentive or carry and affiliate transactions, the other piece of this is effectively the reporting. And when they went to Congress, really Heiser wanted the reporting to be like a operating company, because that's the way he was thinking of it, because it was, I think, in a very much of an internally managed structure. So what you came out with was what we consider a hybrid between effectively having 40 Act requirements and compliance issues, as well as a little more flexibility than you would have in a normal closed-end fund. What Congress took back as a result of that was that the BDCs have to have 70% of their portfolio in eligible portfolio companies, which are usually, or they have to be US based, and they have to be effectively private or up to thinly traded 250 million market cap. So that's where that 70% test comes from. There's very few SEC vehicles that have that kind of requirement around them. And one of the things that happened when the legislation passed was the SEC had thought that there was going to be a huge numbers of these of BDCs started. In fact, there weren't for a number of years. And then in the 90s, the tax rules changed so that BDCs could also be RICs. So as a result of all of those changes and a number of other things that have happened, you now have about you have about 50 BDCs out there, and the assets under management are about 150 billion. But that did take since the 1980s to get to that number. Anyway, just to give you a little bit of background on what a BDC is, and now I'm going to turn it over to Stephanie to talk a little bit about some of the preliminary issues you need to think about when you're structuring an SBIC to a BDC. Stephanie, can you talk to us about what people mean when they're talking about internally managed versus externally managed?
Thanks, Cynthia. Sure. So the two real main structures here, as Cynthia noted, are external and internal. And as she noted, initially internal was the way to go. What that means is, rather than having an external manager where all of the duties, the investment administrative duties have been delegated, the BDC, it's like an operating company where it has employees, it has executive officers, it's subject to executive compensation disclosure, just like an operating company, and everything happens in-house. The team is built in-house, everybody, all the personnel are employees. That in the difference there then for the external is where it's run more like a private fund or a private fund complex, where the BDC would be one of many funds. All of the duties, the operations, day-to-day administrative, as well as the investing decision-making is delegated to an external investment manager and or an external administrator who handles the accounting and valuations and things like that. The manager is then able to engage in other activities, such as launching other private funds, which may co-invest, and we'll talk about that a little bit later, and have other BDCs, other closed-end funds. It can build a platform with multiple entities, and the manager then builds the team. The team, investment team, administrative team is housed at the manager, and there's no disclosure specifically about what the personnel make, although they are subject to disclosure about your management fees and your incentive fees. And the management fees and incentive fees are then built out into an investment management agreement that is subject to both board and shareholder approval. So that kind of gives you the overall background. Cynthia, when thinking about the background and the two structures here, internally and externally, managed, what are some of the regulatory considerations or other considerations that a BDC or an SBIC that wants to be a BDC should consider?
Sure, and I already mentioned that the compliance for a BDC is very similar to a closed-end fund and mutual funds, actually. So the underlying compliance, you have to have a program, you have to have a chief compliance officer. So for either type of structure, either internal or external. But when you're thinking about the external, beyond that, the external has a lot more affiliate issues to deal with. So if you are a manager and you have two funds, regardless of whether they're registered or private, those side-by-side funds, any type of co-investing amongst those entities creates issues, and you're required to get exemptive relief to be able to do that co-investing. So there's more to it than that, but there's affiliate issues. If you're internally managed, the affiliate issues really kind of go away because there's special flexibility for BDCs for effectively downstream portfolio companies, and so you don't have those same kind of issues. Also, the manager has to be registered at the SEC, which is a little bit different than some of the SBICs, if that's all you're managing. The BDC has to be registered at the SEC. You have to go through a process to file an ADV form initially and then on an annual basis. And so all the rules that apply to the advisors under the other 40 Act is applied to that manager of the BDC. And you have fiduciary duties specifically that you have to treat everybody in a fair and reasonable manner. So it's more detailed, but you really have to be careful about that. And then the relationship there really is dictated by the investment management agreement that Stephanie mentioned. And the investment management agreement has to be approved by the board of the BDC initially, and then on an annual basis. Anytime there's a material change, you have to essentially go back to the board. It also has to be terminable within 60 days. So it's, and there can't be any penalty on that. So there's a lot of details that go that, and if you've ever heard of it discussed, it's called the 15C process. The board approval has to be done by a majority of independents. That majority of independents is required for a number of different things at the BDC, but those are the most significant or substantive issues around externally managed. If you're internally managed, then you've obviously got the individuals that Stephanie mentioned that are already on staff, and it's much like any other company with officers and directors. But if you wanted to grant any kind of equity compensation, you have to have that compensation. For example, if you're talking about restricted stock, you have to have that approved by the SEC. So there are certain limitations, restrictions around that. In addition, unlike the externally managed, executive officers have to have their compensation disclosed. So you disclose salary, bonus, and any restricted stock or options that are there. Directors can be part of option and restricted stock plans, but they need to be approved across the board. And those approvals are usually take, around six to 8 months to get those through the SEC process. Hopefully that'll be, we'll be doing that quicker in the future. But anyway, and then if there's other reasons that you might need relief, such as if you wanted to have a registered investment advisor or something along those lines. But those are the primary regulatory outlines. Stephanie, maybe you could talk about how a BDC funds itself, or the different structures that you can use to fund or raise capital.
Sure. So there's really three structures here, three options here for BDCs. One is the more traditional, which I'm sure everybody's heard of, just doing an IPO, raising money publicly, registering with the SEC, and being listed on an exchange. Another option is what we call a private BDC. It's somewhat of a misnomer because it's still a public reporting company. That said, what we're really referring to here is how it's raising money. It's raising money privately, similar to any other private fund, subject to Regulation D, and all of the investors, ultimately stockholders, need to be accredited investors. And it's not listed on an exchange. So that's one of the big distinctions as opposed to a public fund. And then there's the non-traded, which is really kind of the in-between both the private and the public, where here there are investor suitability requirements. The standards are not as high as being an accredited investor because the offering is registered with the SEC, but it also is registered with every single state in which it's selling securities. We call that the blue sky process. And what that means is because the offering is not listed on an exchange, or the securities, I should say, are not listed on an exchange, you don't have the same exemptions from your state SEC or state securities requirements. So that's why it's kind of an in-between. You're registering with the SEC, but you're not listed on an exchange. There are investor suitability requirements, but they are less than what you would see in the private markets. And you often have a dealer manager that is helping the BDC raise the money. I will note, and this will probably come up when we get to our case studies, but the SBA to date has not allowed a private BDC to own an SBIC, whereas the SBICs that are subsidiaries of BDCs are all those of what we call the public BDCs, the listed BDCs. So that kind of gives just an overview on the capital raising process.
Right, and that's really the assessment is just where you want your shareholders to come from, or what market you want to be in, what channel you want to be in, and how do you want a purely public player? You want some private which might go public, and so but the compliance and everything that we've talked about really doesn't change. Similar to your SBIC, if you've got SBIC regulations are out there and are separate and apart from your capital raising function. So just if you divide those two things up. So now we're going to talk a little bit about a case study where recently we did do a transaction where an SBIC platform converted into a BDC. And I'm going to have Stephanie kind of walk through that process. And we've got a chart that we're going to show you on how that was structured. So Stephanie, can you walk us through the steps there?
Sure. And I'll walk through, we've got really two different options here. I'll walk through Main Street, which I believe is up on your screen now first. Main Street, it launched as a BDC back in 2007, and what they did is, as I discussed before, that oftentimes the SBIC is a subsidiary, ultimately a subsidiary of the BDC. So when we talk about a conversion, there's really two options. It's keeping the SBIC outstanding, remaining under the SBA's SBIC program, or having the SBIC go away. And with Main Street, you can tell from this chart, there are a lot of moving pieces. But what they ultimately did is they took the private fund, the SBIC, which had LPs and a GP, the general partner, as well as an investment advisor, and they offered to exchange the LP interests for shares of the newly formed BDC. They bought out the GP using cash, and then they used shares to buy out the interests of the investment advisor and wrapped that up into the BDC. Main Street chose, as I mentioned, to maintain its SBIC license, and the SBIC operated as a wholly owned subsidiary of the BDC. So it maintained its debentures. And also under the SEC program, or the BDC program, you're able to get exemptive relief and not count the SBA leverage towards your asset coverage, which is a real bonus for leverage purposes and how you're operating the fund. And it went straight to an IPO. So it did its formation transactions and raised money in the public markets and was an exchange traded BDC. Now, if we can go to the next slide, we'll talk about the other way.
And Stephanie, just while they're going to the next slide, there's been a couple of different structures. These are only two of them. There's also one where the SBICs were converted all except for one. One was maintained outside. And then I think people may be familiar with Triangle also did a conversion. But what we're going to talk about here is the most recent conversion with Trinity.
Yeah, and so the structure that Trinity decided, they made an executive decision here that they've kind of lived the life that they had in the SBA program, and were opting to convert just to a BDC and not maintain their SBIC licenses. So as you see from this slide, again, Trinity had some private funds, it had 2 SBICs. And what they ultimately did in their formation transactions is they merged all of their funds, both the SBICs and the private funds, into the BDC, with the BDC being the surviving entity. They used cash and shares to buy out the LP interests in all of the private funds, including the SBICs. And then they used shares to buy out the GP interests, and also cash and shares to the investment advisor. So if you go to the next slide, it'll show you the post-transaction, whereas you can see it's much simpler here. There's a BDC, they have one wholly owned subsidiary, there are some, and then you have the BDC, and that's really it. Trinity, like Main Street, opted to stay internally managed, so they are subject to the executive comp reporting and all those things that Cynthia touched on earlier. But they did surrender their SBIC licenses. They repaid the SBA debt and came out from under the SBIC program. So again, making this structure simpler on a page at least, where you just have the one regulated entity, the BDC, without any SBIC subsidiaries. So again, that's a pretty high level overview, but with that in mind, Cynthia, do you want to maybe touch on some of the, especially since we have the Trinity slides up here, some of the regulatory considerations that needed to be addressed with respect to the formation transactions?
Sure, and one of the things you have to be very careful is structuring these, because as Stephanie was talking through, you're going from having private investors and a regulator, all of which need to be dealt with as far as how it's going to look to them going forward, whether they're going to continue on, whether they're going to be paid out, how they're going to be paid out, and then the SBA, whether there's going to be an SBIC or not, and what you may want to do with an SBIC license at some point in the future. So in the Trinity example, one of the first things you've got to do is you've basically got to do diligence, which is no surprise, because once you make an election to be a BDC, you have to come within the 40 Act rules. So when you're doing that diligence, one of the things you need to be looking at is what kind of affiliates or affiliate transactions you have at the time, and what are you going to do going forward. So for example, are you going to have several funds? So for example, if you're an external manager and you've got a BDC and a private fund, are you going to want them to co-invest together? And if they are, then you need to do an exemptive application to the SEC. And until you get that exemptive application approved, you can't do those co-investing transactions. So you may need to work into your modeling how that's going to work, because these days a number of people want platforms where you have different pockets of money, whether you've got the private funds, public funds, or SMAs, or whatever vehicle you're using. So you want to think through that from a standpoint of how you're investing. And then we already talked about how you're going to raise capital. Obviously, you would likely have a banker involved in this, and you want them to address the market, how you're going to market. But before you get there, you've got to deal with the LP structure and your formation transactions. Those formation transactions really need to be put together before you become a BDC, because once you become a BDC, any type of formation transaction, including the LPs or other funds, are now your affiliates. So you got to make sure that those transactions can effectively be put together anytime before you make your election to be a BDC. So you could do a day before or something along those lines, but you can't come afterwards, and you can't pay for it afterwards. In addition, you've got to look at the portfolio. You've got small businesses that meet the SBA definitions, but what do they meet the BDC elections? Usually they will without much issue, but you got to go through it and look at that. You also have to look at your leverage, which Stephanie already mentioned, and Trinity, they paid back the leverage that they had gotten because they got a separate borrowing or financing, and that the timing on that had to dovetail so you didn't go over the leverage requirements that the SEC requires. And then you got a RIC election. When you're going to make that RIC election with a new entity, you have to be a RIC for the whole year or the year that you are in existence. And so you got to look at the timing on that. How is that going to work? Also, valuation. Valuation's a bit different for BDCs. It's a market-based structure, and the accountants are involved. So you wouldn't be using the same SBIC valuation rules that you do today. So you got to work through that. Usually, like I said, there's a third party involved that helps, but that would have to be put together prior to making your election. And then, of course, you got to deal with your current regulator, which is the SBA, and what they're going to do, because you're going to need some type of approval. So you got to decide when you're going to talk to the SBA and talk to them about the process and the timeline around that. So Stephanie, maybe you can talk through some of the timing questions or issues around the conversion and the BDC election.
Sure, just Cynthia's mentioned some of these, but I'll go into a little bit more detail here. So as she noted, we'll start with the SBA process. You know, depending on what you decide to do, whether you decide to keep your SBICs outstanding or whether you decide to surrender your license, there are going to be really two different timelines there. The first is if you're going, like Trinity did, for example, if you're going to surrender the license, you need to be able to repay all of the debt, surrender your license, and revise all of your underlying org docs to not be basically holding yourself out as an SBIC. The SBA is very particular about that, and they actually want to typically see revised documents, or at least drafts of revised documents, showing all removal of any SBA, SBIC type provisions. And oftentimes you'll need to also look at the underlying documents to understand what type of approval you need from your LPs. It could be that the documents are drafted such that you don't need any approval to repay the debt and no longer operate as an SBIC, but oftentimes the documents require, because this is a change in structure, a change in operating, so oftentimes the underlying documents, your LP agreements, will require also that you get LP approval to relinquish your SBIC license and no longer operate as an SBIC. So as you can imagine, both of those items related to your structure as an SBIC takes some time. You know, it takes time to prepare the documents, but then also walk the SBA through your process, answer LP questions, etc. On the other side of things, if you're going the route that Main Street did, or for example, Cynthia mentioned Capitala, which kept one of their licenses, there it's really a change in control or a change in ownership at the SBIC level, because you're going from just having your LPs, which the SBA is comfortable with, they gave you the license, they're okay there, to being a public reporting and a publicly owned company listed on an exchange. So they want to be comfortable that there are no changes in managements going to the new structure, and also that your change in operations is not going to really impact your portfolio companies. I think one of the things that we haven't really mentioned here is the SBA is very focused on the portfolio companies and making sure the portfolio companies are okay, where the SEC is very focused on the shareholders, your LPs, and making sure they're okay. So you've got these two competing interests as you're going through this process and deciding what to do and then getting the appropriate approvals. From there we go to the SEC process, and there it's basically the same regardless of whether you want to keep the SBIC outstanding or not. That comes down to disclosure and describing what your post-transaction structure is going to be. For example, when we had the Main Street slide up, you had all of the SBIC and the GP subsidiaries under the BDC, whereas the Trinity structure post-transaction is a little bit simpler. But as Cynthia noted, you have to deal with the affiliated transaction issues. So you have to make sure that you're not electing to be regulated as a BDC until you have any sort of structuring, pre-transaction structuring completed. In the Trinity model, again, this was more complicated because they were relinquishing the licenses and basically rolling up all of their private funds into one entity. So the mergers had to be done prior to the BDC election. And also there, they had to make sure that they had the cash, practical considerations, right? You need the cash to pay back the license, and you need the cash to if you're going to pay your LPs and give them the option either to roll into a BDC or get out of the fund complex entirely, you have to be able to give them, pay for their interests. And so in the Trinity transaction, as Cynthia noted, they got a credit facility to pay off the SBIC debentures and surrender their license. All of that was done prior to really prior to the formation transactions, although I will note it happened very quickly, within minutes and hours. And then they had to complete all of the mergers. And with Trinity, there were 4 funds, plus the GPs and the investment advisors that all rolled up into the BDC. So they had to complete all of those mergers, which, as I'm sure most on this call know, it's you get all the documentation done in advance, and it's you do your filings and you're done. But all of that had to be completed. And then the next step, once you get through all of that, the next step is your BDC election. But you cannot elect to be a BDC until you have securities registered under the Exchange Act. And that's where the Form 10 comes in. I haven't really talked about the Form 10. It's really akin to an annual report on Form 10K, that same type of disclosure. So it doesn't have all of the offering materials that you would see in a prospectus for an IPO offering, but it's very fulsome disclosure about the newly formed BDC, but then also what the newly formed BDC is going to be. So and the reason that was done in Trinity, again, is because they opted to be a private BDC first. They weren't going down the road of being a public BDC and launching into an IPO right away, whereas differentiating the Main Street transaction, the Capitalis transaction, and the others that are out there, they went straight to an IPO and had your prospectus and did the offering. Both had fulsome disclosure about the what we'll call the legacy assets, the legacy portfolio, with all of the accounting, the financial statements for the legacy portfolios, valuations of the legacy portfolios, and very fulsome disclosure. So that kind of talks about the timing. And again, just to take a step back and reiterate, it's for pre-transaction, formation transactions are done. Then you file your Form 10 or your prospectus to be registered under the 34 Act, or really it's a Form 8A that goes in conjunction with your prospectus for the IPO process. Then your BDC election, because you don't want your BDC election too early in the process, and then you're subject to the affiliation and joint transaction rules and prohibitions. So that's a lot of information there about the timing. I'll take a break, and maybe Cynthia, you can talk about some of the legal approvals that are needed in addition to what I've just talked about.
Right. So just talking through, how do you roll this out? How do you tell your LP investors that you might want to do a BDC? Effectively, that's going to be very similar to the type of information you would find in a prospectus or a Form 10, similar to what Stephanie spoke about. So, but you've got to tell them kind of what you're asking them to approve, what you're going to do, and what the BDC is going to look like, including the regulatory structure. So that the timing on doing that and how long it will take you to get the consents from your LPs, you have to factor that all in. So that's a fairly significant disclosure document, and how you're going to talk with them and discuss with them kind of your move or your proposed move into this type of structure. Obviously, you have to also work through the SBA and explain to them what the plan is, how it's going to be structured, what the timeline is going to be, when you'd like to potentially either continue through a change of control of your license or a surrender. As most everybody knows, it takes some time to get everything pulled together, and mostly you're talking about just explaining the transaction and potentially giving them the information about the consent. And then also the surrender. It's really the critical piece there is obviously the payoff and the surrender, and getting that done on a timely basis, because a surrender of a license requires the SBA to go around and make sure there's no other issues, no reason that you can't kind of get out of the program. Just to keep in mind, you can always get back into the program. There's no reason you can't. And then we talked about the BDC election. Depending on what form of capital raising, that'll dictate what you're going to have to file at the SEC. BDCs use a registration statement on Form N2, or as Stephanie mentioned, for a private or non-traded using a Form 10. Effectively, the same kind of information is included. It's what is your plan, what are you going to invest in, who is your management team, and what is the regulatory structure. The biggest issue here is how do you deal with the accounting for the legacy portfolio, for the legacy portfolio. And it's not uncommon in these type of situations, because there's not that many examples out there, that you might not need to go into the SEC and talk with them. Are you going to need to have full-blown financial statements around the whole portfolio, or are you going to do something like a schedule of investments? And there's some new rules out there about what you need to do, but spending some time with your accountants on how to come up with those historical financial the financial data, so you know what has to be included, is really important, and takes a bit of time. And obviously, accountants have to potentially provide an opinion or pro formas, and they've got to get through they got to get comfortable with all of these documents. So you got to make sure that they're very, very involved. Not only are they going to be involved in this formation transaction that we've been talking about, but also going forward. So your independent accountants are critical here. And you have to make sure that your election's made in an appropriate way, and as far as an N2, the filing of a registration statement really is the same as for any other type of registration statement. It's a comment review process. The SEC takes about 30 days on an initial review, and 15 to 20 days on second or third reviews. So you're talking about kind of a 3-month time frame around having an N2 reviewed. A Form 10 can be a little faster. It actually goes effective immediately, not immediately, excuse me, within 60 days, which it seems like immediately. But if you needed more time, you can always withdraw it and refile. So it's there are a number of structuring and timing requirements around this, and you have to have in place when you start up. You've got to have your board of directors, and we haven't focused too much on the board of directors, but that has to be a majority of independent. So all of these documents that we're talking about, all this process and compliance, has to be kind of run through them in kind of an org meeting. So one of the critical things you need to do is to really go through and set forth your team, which I think you've heard me already mention. You've got to have obviously legal, you've got to have your accountants, you've got an investment banker, so there's a lot of different players here who all have to come together and need to know kind of some of the background here. And then you need a timeline. How is this all going to work with the financials? Because if you're in June, are you going to be able to pull this off by September? What is the timeline? So there's a lot of critical pieces here. Stephanie, anything you want to add to those?
Sure. One thing I think we haven't touched upon really is the role of the underwriter and in the process. And you know, it's probably pretty obvious when the company is doing their IPO what the role of the underwriter is. Maybe a little bit less obvious if the BDC or the management team decides to go first with a private fund structure that then converts to a publicly traded BDC at a later date. And the reason I bring this up because it impacts your involvement with your LPs. Underwriters often, because they want to manage the market, they want lockup agreements from shareholders and from your LPs. And so consideration has to be given to how you're going to get those lockup agreements. What percentage of the shareholder base do the underwriters want to be locked up? Is it just large institutional shareholders, LPs? Is it all of them? Is it as many as possible? Is there a way to build in any sort of lockup provisions into the LP approval process for the BDC approval process as a whole? How long those lockup periods are going to be, depending on if it's a BDC that is thinking about going public ultimately down the road, or a private BDC that's thinking about going public down the road. How does that timing play into the lockup agreements that ultimately the bankers will want from shareholders? So just one thing that we haven't really touched upon, but you know, Cynthia was talking about making sure you're fully engaged with your accountants, for example. You want to also be fully engaged with your financial advisors and your investment bankers, and how they want to ultimately position the BDC, how they see your operating structure and your current shareholder base. So that's one thing I would add to that. I guess the other thing I would add is we've alluded to the portfolio valuation. Cynthia noted that the valuation process is a little bit different for BDCs than it is for SBICs, and that it's market-based. I'll also note that when you're thinking about any sort of formation transaction where you're converting from a private fund BDC structure to a BDC structure, you have to think about making sure that you have third-party valuation agents involved, because the accountants are going to look for that guidance when they're looking at financials and converting, most likely converting, because the private fund probably doesn't have, this SBIC doesn't have SEC compliant GAAP financial statements. And so the independent third-party valuation firm is going to be helpful both in getting the board comfortable with approving any sort of consideration that's going to be paid to existing LPs, whether it be cash or even figuring out the exchange from LP interest to shares, but then also helping your accountants get through their audits of financial statements. So I guess those are 2 points I would add to that. Cynthia, anything else?
No, I would like to talk just for a minute about the fact that we're talking about the conversion that Trinity did as kind of a case study where they went into a private BDC, which, as I mentioned before, again, that's really your capital raising piece, but the compliance kind of kicks in as soon as you make the election. So Trinity, for a year, was a private BDC. They were reporting at the SEC. They had to do all the compliance and the valuations that Stephanie just mentioned. So there was that period where people got an understanding of who they were, what they were, but then they decided to list, as far as being a traded BDC. So Stephanie, can you walk through that process a little bit?
Sure. I think the first decision point was whether they were going to do a direct listing or do an IPO, raise additional capital, and list through that process. Trinity, obviously, I think as everybody's probably seen in the market, opted to do an IPO. They completed that earlier in 2021, earlier this year. And the process there is, again, as I noted, working with your underwriters and figuring out what the market is, how the market windows open, what the timing is, when the BDC needs capital, how much capital it needs. But the process for listing at that point And the IPO process becomes, the offering process itself is similar to any other offering process, whether you are converting an SBIC into a BDC or not, because like Cynthia said, they'd been operating for a year, so it was a matter of going to the SEC, getting the registration statement approved, launching the IPO with the roadshow, hitting the market windows to get all of the timing done correctly. The other option, of course, would be a direct listing. There are very few companies out there that have done a direct listing. And the hurdles there, because you don't have a market price being set for your listing price through the offering process, what the listing agencies want to see is they want to see and help figure out how to establish that opening day trading price, because it's not based off of an offering that has gone through a market price. And that would require a full valuation of the company. And this is not just a portfolio company valuation, which I think whether you're operating as a BDC or as an SBIC, you know what that is, albeit slightly different, but a full enterprise valuation that pulls in both your valuations of your assets, right? Your portfolio companies, your investments, but it's a full enterprise assessment, which could be a little bit different depending on whether you're internally managed or externally managed and what exactly is housed at the BDC. So those are two kind of decision points as to, you know, where the BDC is at that point in that stage in its operations and what its needs are.
Yeah. So I would just say that when you're looking at the possibility of using a BDC for mostly for capital raising, and we haven't focused a whole lot, but one of the differences is the BDC doesn't have the same requirements around the portfolio restrictions that an SBIC does. So if you know, whether you want to continue operating SBICs or adding new ones, or you want to do something that doesn't necessarily fit in the SBIC, the BDC is a potential vehicle for you to look at. And what we're trying to emphasize is there's a lot of variables. There's a lot of things that you need to think about and how you want to run your business, because you may want to run it differently than others, and then you know, how you're going to move forward, and being able to kind of implement all of those things and structure it in a way that makes sense for your team. So those are the types of things that that we're trying to emphasize here. But again, flexibility and variability, I think, is the thing I would walk away from. Is there's a lot of decision points that you need to do up front, and obviously choosing a team that has some background or experience is important. And I know that when people are looking at this, they talk to a lot of people, and I would think that is one of the most important things you can do when you're thinking about making this kind of a change. So Stephanie, anything else you want to add before we sign off for the day?
I think that's it. I'm looking, it doesn't look like we have any questions at this point. So maybe, you know, 20 seconds if someone wants to add, I can fill some time here. 20 seconds if somebody has any questions, but certainly if you don't have any questions today, or if you think of something in the future, please don't hesitate to reach out to either Cynthia or myself. Obviously, we've been through this process. And as Cynthia noted, there's a lot of decision points. So we're happy to talk with anybody that has questions about the process.
And we have an app that has a number of our presentations on it called BDC Essentials. It's on the apps in the app stores. So if you wanted to look up any of those presentations and get more detail about the regulatory structures of BDCs, you certainly can go there, or obviously call us, and we'd be happy to talk you through the various issues that arise. So if there are any questions, I think we'll sign off for this afternoon. Thank you for joining us, and we'll talk to you soon.
Thank you, Cynthia and Stephanie. We appreciate the time and expertise that you have so graciously shared. If Cynthia and Stephanie were not able to address a question, they have generously agreed to respond after the webinar, so please email them directly. Thank you for this valuable conversation. A replay of today's webinar will be distributed to SBIA members and will be available on our website at sbia.org, where you can also view previous webinars and materials. Our next Lunch and Learn webinar will be next Wednesday, October 27th and will feature a discussion on the LIBOR transition and key considerations after the year end. Details will be shared in membership emails and through SBIA's LinkedIn and Twitter pages, and you may register on the SBIA website. In addition to the SBIA webinar series, we encourage you to participate in one of our upcoming small group networking events. There's Nashville next week, Naples, Florida on November 11th, and a women's holiday event in Chicago on December 2nd. Please visit the regional events tab on our website for details and to register. And finally, if you're not an SBIA member and would like to learn more about joining our organization, please email membership@sbia.org. Thank you again for participating in our webinar today, and we look forward to having you join us at an upcoming SBIA event.